All right. So hello, everyone. Thank you for tuning in. Tonight we're going to talk about how to conduct due diligence for an investment deal. And so we have a special guest, Tommy Beyer. He's a hotel expert, and I call him the human calculator because he's really good with numbers and he's really good at explaining how to analyze deals so that way you'll be more prepared and what to look for when you're investing in a deal. And hopefully you'll use this information to analyze a deal and invest on Vesterr. So Tommy, he got his start off as a valet attendant, and then he navigated his way to becoming a general manager of a hotel, actually one of the youngest to do it before 30. And then he started working then he moved his way up in the corporate for a third party management company. And then he went over into another corporate side and launched a REIT. And now he has his consulting firm called B Hospitality. Did I get it?
You got it. You're all over it as usual.
Woohoo! No notes, baby. Well, so y'all are in great hands when it comes to Tommy. Thank you all so much for tuning in. And he's going to walk you all through how to analyze and invest in deals. So I'm gonna pass it over to him.
All right, guys. Well, it's good to be with you tonight. Thanks for joining in. Certainly appreciate that. We know Kimberly's from South Carolina. We know Dylan is from Canada. So, uh, where's everybody else from? Let me know. Throw it in the chat. Where are you guys from? Anybody from Georgia? Down where Davon is? Oh, Maryland. Okay, so I am in Virginia, so I'm not too far from Maryland. Chicago. Cool. All right, it's good to be with you guys. Tampa, Florida. All right, good. Um, well, good. Well, I don't know how many people have heard me speak before. I'll joke on myself for a minute. My wife says that I sound like Ben Stein, if you remember that guy. She's like, "Man, you put people to sleep." Like she's like, "You're so monotone and all this." So, um, but my counter to that is this is, hotels can be exciting, but analyzing deals, working through numbers, it's not the most exciting stuff unless you're like me and I love numbers. So yeah, so I'm here to run you guys through due diligence. And, as Davon mentioned, I've got a lot of experience in hotels. It's all I know. Don't ask me about anything else besides hotels, or I'll just look at you with a blank stare. So, like I said, I eat, sleep, and breathe it. Literally started parking people's cars at a Four Diamond Resort down in Charleston, South Carolina. Went to University of South Carolina for hotel management. Did some coursework at Cornell. I've been kind of done all kinds of jobs in the industry. Yeah, I'm happy to say that Davon and I have been good friends for 15 years or so, something like that. But yeah, excited to be here with you guys. And tonight we're going to kind of focus a little bit on investing or analyzing a deal from a passive investment perspective. So, just to understand the difference, I know Davon's been over it, and I'm sure some of you guys have listened to her in the past, but the difference between passive and active. Anybody know the difference? Anybody want to raise your hand? Let me know what you think. Type in the chat, jump in. Um, you've heard of everybody heard of LPs and GPs? It's a smaller group, so we can kind of be pretty interactive too. So LP being limited partner, GP being general partner, and the LPs is kind of what we're focused on tonight. So, and the difference being LPs are passive and GPs are active, meaning if you're an LP, you would just be sending a general partner or a sponsor your money to invest in the deal. And you're just saying, hey, look, I either don't have time or I don't have the expertise, um, but I want to be a hotel owner, right? So I want to put in 10,000, 5,000, 50,000, 500,000, whatever it is, into this hotel deal and own part of it as a limited partner. And again, the GPs are the one that are managing the deal, right? So they're actively sourcing the deal, they're sourcing the debt, they're sourcing the equity, they're finding the management company or they're finding the franchisor. So they're in it, right? They're really busy. They're staying, um, really active in making sure this deal is successful. So again, tonight we're focusing more on LPs. So if you came here to learn about GPs, tonight's not your night. I'm sorry, but um, and some of this translates though. To be fair, so some of this due diligence is similar. So I want to walk you guys through, sort of the way I look at deals when I'm thinking about investing in one. So I'm going to share my screen here. Let me close out of some of the 800 tabs I have open here. So let's share my screen. And the first thing, and it sounds really basic, that I do is, okay, so let's say somebody tells me about a deal. And I'm going to walk you guys through kind of a deal that I've been looking at lately, actually. And this deal it's not in Tampa, Florida, but it's in Vero Beach, Florida. So it's a Holiday Inn Express in Vero Beach. Anybody ever been to Vero Beach? Anybody know anything about that area? So the first thing I do when somebody tells me about it is I jump into Google Maps, right? And I need to understand what the market is, right? So let me pull this over here. So I need to understand what are the demand generators, what's nearby, what does the area look like? So this is a Holiday Inn Express off I-95, which I'm sure sounds like we got a lot of East Coast people. So everybody knows I-95, right? Super busy. I guess the busiest highway in the country, I'm thinking. Um, so I zoom out, right? Because somebody says, okay, here's the hotel. Zoom out. I need to get a good lay of the land. If you're not familiar with where Vero Beach is, uh, it's just north of West Palm. It's a couple hours north of Miami, right? And it's south of Daytona. Call it between West Palm and Daytona. Um, Obviously, well south of Jacksonville and south of Orlando. And it's on the coast, on the East Coast, not quite on the ocean, but not where this hotel is, anyways. So now I understand where it is. Everybody got me? We're following. We're in Vero Beach. We're off I-95. So now I zoom in a little bit more, right? And I'm taking you guys through an actual deal that um, is out there for sale right now. That this hotel owner would sell. That I've actually talked to a couple people
Place
about
to.
buying it.
Let's see.
So um, so the hotel is here. Here's your Holiday Inn Express. One thing you notice right away is we've got an outlet mall here. Okay, so that's good. And I'm looking for demand generators right now. I'm trying to get an understanding of um, if I were to buy this hotel, who would come stay here, or how can I make sure this hotel stays full? And usually, when I'm buying a hotel, I want to make sure there's a couple different demand generators, not just one. If you can find that, you're doing better off. So I-95 on itself is a demand generator. And you might say, well, how is that so? Well, you've got hundreds of thousands of cars driving past your hotel every day. Okay. Um, but it doesn't mean that every hotel off I-95 is a good property, right? So, or a good exit. So there's a difference on highway exits between good and bad exits. And just think about it. Like when you guys go travel, there's exits that you probably usually get off on. Maybe there's a Bucky's, maybe there's a gas station you like, maybe there's a restaurant you like. But usually you're looking for a couple things. One, that it's kind of easy on and off. Two, that it's got like some restaurants or something to choose from, especially if you're going to spend the night, right? So you want to be able to spend the night, get gas, go to a good restaurant, and be in a safe area, right? Does that make sense? So, not every exit off of a highway is good, right? It might have one hotel and one shady gas station that looks like somebody just got, uh, mugged right before you got there. So you don't want to stay at that one. But this isn't that way, right? So you could see right away. We have a restaurant here, Steak and Shake. We have a Cracker Barrel, right? So that's good because people will stay. They'll eat it. Maybe they'll eat at a Cracker Barrel. I'm also looking for who's my competition. So right now I could see I've got a Hampton Inn next door. I've got this what's called a Vero Beach Hotel, so that's an independent property. I have a Home 2 Suites here, and I have a Fairfield Inn and a couple of other looks like independent properties there. So there's some competition. I wouldn't say a ton, but there's enough. There's an older Red Roof Inn, a hometown. There's a fair amount of hotels, but some of these you're not going to be competing with, right? Because as a Holiday Inn Express, you have to think about who would you compete against. You would compete against the Hampton Inn, right? I'd compete against the Fairfield, probably the Home 2 as well. Um, and I thought I'm pretty sure there was a Comfort Suites in here as well. Um, so I'm looking at thinking about, okay, is there a lot of competition? Who's my competition? And then I also want to get a feel for um, is there a place where somebody could build another hotel? So if this market starts doing really well, if you know Microsoft or Amazon or whoever it is wants to build some massive facility out here, because there's a lot of land, right? These are all farms out here, and these hotels are doing really, really, really well. Can somebody go build another hotel? And the answer to that question is yes, they can. So I'd say this has limited barriers to entry because look at all this land. I just see green, 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 green. So if somebody wants to build another hotel, they can buy some of this land and go build it. Um, again, back to demand generators. I know we're hopping around. So we're thinking about demand generators. Is it a good location? Um, what is it nearby? So we've got I-95, we've got the outlets, which is good in case people want to go shopping. And then, you're not too far from the beach, but you're far enough to where, the chances of people staying out by the highway to go to the beach aren't very good. Um, but I have a little cheat code because I grew up not too far from Vero Beach, and I can tell you there's not a lot of good hotels out here. There's a lot of older independent stuff. So um, so I think it's an okay location. If I'm going to rate this, I'm going to say it's maybe a B, something like that. I don't think it's an A location, but I'd say it's a B. And the other thing I want to think about as it pertains to the highway is um, can people see it? So if I'm driving down, let's get back on the highway. We're under the high right here. If I'm driving my car down I-95, let's see, can I see the hotel from the highway? So let's see. So here's the Hampton Inn. And this is so nice to have Google Earth. I mean, back in the day, right, we'd have to jump in our car or somebody have to take us a picture or something. Here, yeah, so actually this is the Hampton Inn. This must be that independent hotel because yeah, so that's the Hampton Inn. The Holiday Inn Express is tucked in back over here behind next to the Cracker Barrel. So it's a little hard to see. Let's keep going down. And the reason that's important is you're talking about visibility off of the highway without having to pay for a billboard, right? So I'd say it's a little difficult to see, so that's not great. If I'm one of these, I'd rather be the Hampton Inn because people could see it really easily. This one's kind of tucked in and hidden behind some trees, so I don't really love that. Um, so, any questions, thoughts, concerns? You get that? Does that make sense while you're looking at it, right? And I try to relate this back to saying if you're buying a house, you're gonna look at the house, you're gonna go walk down the street, maybe you're gonna go visit it at night, you're gonna go ask the neighbors, you're gonna get a feel for like, is this a good area or not, right? It's the same difference. You're just buying a commercial building, and now we're figuring out who's gonna come stay, who's gonna fill your hotel up, right? Um, and just so we know, what we're looking for in this case, it's a Holiday Inn Express. This is a more transient hotel, meaning people are going to stay with you one night, two nights. You're probably not going to get a lot of people that are going to stay there for, weeks on end because it's not an extended stay hotel. If you were looking at an extended stay, like maybe something like this Home 2 Suites, um, you're going to be looking for different demand generators. We're going to be looking for big corporations, industrial business, things that are going to lead to people staying at your property for a week or 2 weeks or a month at a time, right? Um, so in my mind, this location is better suited for the more transient guests because they're coming up and down the highway. I don't think it's as better as well suited for extended stay because I just don't see a lot of businesses that would fill you up for that extended stay piece. So first thing we're doing is looking at location. Next, let's get into it. You should get an offering memorandum. It should either come out from the broker, or it should come out from whoever the GP is. Maybe they'll send you a pitch deck, right? Which is going to be similar to this offering memorandum. And if we have time, I can run you guys through a different pitch deck. Um, on a deal that Devon and I's partner put together in the past. But anyways, on these offering memorandums, you're going to see a lot of interesting information. But I'm going to kind of run you guys through it quickly, and I'm going to skip all the stuff you don't need to know. Right. So I'm giving you the cliff notes here. So first thing is going to tell you the address. We already know that. We already looked it up, right? How many rooms? Okay, that's important to know. Want to know how many rooms can I sell? What year was it built? And that's important in a lot of ways. When we're thinking about these limited service properties, when I say limited service, I mean it doesn't have food and beverage. It doesn't have valet, bellman. It's a limited service, right? So it may give free breakfast, that kind of stuff. The age is important, and the reason it's important is because these brands, this is an IHG hotel. Holiday Inn Express is IHG. These brands will only allow you to be a branded hotel with that flag for a certain number of years. And a lot of people are saying that years are around, 30 to 40. And that's going to vary by location. But in this case, it was built in 1998, so it's 27 years old. Okay. And when you sign up with a franchise, they're going to give you a license. It's going to be a 10-year license, 5-year license, 15-year license. You usually want a 15. You want to get as many years as you can. So if we do the math, this is already 27 years old. And if you get a 10-year license, that's going to take it to 37 years old. So when you go sell this hotel, the next person who buys it is not going to get a long term with the franchise, and they're gonna discount the property as a result of it, because they're gonna say to you, I'm gonna pick on somebody. Oh, they'll say, Davon, that's great. You're selling me this Holiday Inn Express, but it can only be a Holiday Inn Express for 5 more years. And then I don't know what to make it. I'm gonna have to make it something that's not as nice as a Holiday Inn Express. So just keep that math in your head. Um, you know, that's a good rule of thumb. As you get into like full service, historic, age doesn't matter as much, but with these limited service hotels, it makes a big difference. So ownership, fee simple. Anybody know the difference between fee simple and leasehold? You know what that means? Anybody know what fee simple means? Pop it in the chat if you know what fee simple means. You guys are getting quizzed tonight. So there's two different ways you can own a piece of real estate. Right, you own it outright. Kimberly's right. So fee simple means you own the land that's underneath it, underneath the property, right? Leasehold means it's a leased property that somebody else owns the land. You want fee simple. You always want that. Doesn't mean you shouldn't do a lease deal, but if you can get fee simple, that's what you want because you want to own the dirt, right? There's value in that. And then the amenities, it tells you what the hotel has. So sometimes it's interesting to look into these overviews and read what they say. Sometimes they'll tell you, they'll say, hey, you could change this to a different um, flag. They kind of tell you that in these investment highlights. So what they're saying here is offer below replacement cost. Replacement cost meaning if you were to go build this hotel brand new, what would it cost to replace this? Uh, Brokers will tell you that kind of stuff all the time. It's not really fair. It's not a fair metric anymore because it costs so much to build these hotels. But it is helpful because, as we said before, if there's a lot of vacant land, if somebody who's going to have to go build one of these, it's going to cost them more. and as a result, they're going to have to be able to push their rates to be able to pay for their building. So here it says significant operational upside. And that's important to know about this specific deal. Here they're saying you can improve um, operational efficiencies, you can improve the RevPAR, uh, and you can improve cash flow. So we'll dig into that a little bit on this hotel. I believe that to be true about this deal. Otherwise, I really wouldn't look at it. And it says institutional branded asset. Um, So, yeah, Kimberly asked about the rule of thumb for the age. It's a good question. So remember, most of these limited service hotels, so think about like Hampton Inn, Fairfield Inn, Holiday Inn Express, Residence Inn, that kind of stuff. The franchisor, meaning Hilton or Marriott or IHG, is usually only going to allow you to be that brand for somewhere between 30 to 40 years. And in this case, this one's already 27 years old. And the reason they do that is a couple things. One, think about a house that was built 30 or 40 years ago. There's design elements that were in fashion then that just are nowhere near what people want today. And it's the same with hotels. So hotels that were built in the late 90s or even in the 80s, they're built differently, right? Maybe the bathrooms are smaller, maybe the ceilings are lower, and these brands don't want that. They want to sell a new franchise to somebody else who's going to build the latest and greatest and coolest thing, right? And they do that because then the guests want to go stay in that hotel, right? We've all been in a hotel that's old, but somebody, renovated, but it still kind of feels a little old because it's just the design is different. It's just not how new hotels are, right? So again, that's the bad news. The good news is these brands have come out with conversion brands. So they may say to you, "Hey, you can't be a Holiday Inn Express anymore, but you can be what's called Garner. It's a new brand by IHG, and it's a conversion brand. Um, it's not as strong as Holiday Inn Express though, so you're always kind of trading down. So just keep that in mind. You'd like to get something a little bit newer if you can, but it's going to cost you more money. So, yeah, that's a good question. So, here's your hotel, here's the demand generators. You got to be careful with some of this stuff because some of it's not going to bring you any business. This botanical garden way out here, that's not bringing you any business. Uh, this service center for Florida Power and Light, that's not bringing you any business. Now, this one, Jackie Robinson Training Complex, that's a good one. And I'll show you guys why I think that's a good one. So it's a little bit down the road. I remember seeing this not too long ago when I was looking at this deal. So here it is. Okay. So it's not super close. But this is really, if you see something like this for near your hotel, it's usually really good. And the reason it's good is, these parents are kind of crazy these days with their travel sports and their kids. I have kids. They don't do travel sports because I'm not crazy. But if you look at it, that means they're going to go, this weekend to Vero Beach and next weekend to West Palm, and they got to stay for 2 nights and whatever, and you got to stay in a hotel. But these kinds of complexes can bring in a lot of business. Um, so if you see that, that's a good thing for your hotel. But it's a little far out. I mean, it's not super far, but again, as I said, remember I told you this area has a bunch of independent, older stuff, and the branded stuff is here. So all right, so we're going to keep on moving through this offering memorandum here. So let's see, what else do we have? Um, let's kind of, let's kind of skip through. Sometimes you can find deals that are encumbered by management or encumbered by debt, meaning you have to take on whoever's managing it, or you have to take on whatever debt they have on it. Sometimes that can be a good thing. Usually, it's not though. Um, So let's keep going. We'll keep moving through here. Another part of due diligence is, let's understand some more about it. How many acres is it? So this is 1.78. Sometimes you could find a deal that's got some extra land attached to it. You could sell that land, or you can develop on that land, or what have you. So that could be a value add. Um, this is also telling you how it's framed. So in this case, it's masonry, so that's good. It's concrete building, um, which is helpful. It's helpful from a couple things. One, this is Florida. Florida gets hit by hurricanes, although not this year, knock on wood. So it doesn't get hit by hurricanes this year, but usually it does. So you have a concrete building. Two concrete buildings, there's less noise transfer between the walls, right? So if you don't, you're not as likely to hear the people with the screaming kids next door, or um, somebody jumping up and down upstairs or whatever. So that's good, and, the brand is usually a little more favorable on giving you a longer license because they know it's concrete and not wood. Um, so we'll keep moving through. Alright, so let's look at this. Is everybody familiar with the terms? I mean, I'm going over basics, but, we got a broad audience. Does everybody understand how to calculate occupancy, how to calculate ADR, and how to calculate RevPAR? Everybody got that? We're good? Does anybody not know those? We need a refresher. Just pop it in the chat if you do need a refresher. I don't. There's no bad questions. It's a safe space tonight. So, all right, refresh. I like it. Okay, cool. All right, so occupancy is super easy, right? The formula is just the number of rooms sold by the number of rooms available. So remember, this hotel has 65 rooms. You can calculate that per day, per month, per year, however you want, right? It's pretty simple. But in this case, they said the hotel sold 70% occupancy, 70.4%. So it's pretty easy, right? Devon calls me the human calculator. I don't think that's true, but it's a term of endearment. So let's pull up a regular calculator. So 0.704 times 65 rooms times, so that's how many rooms they're selling per day on average, 45 rooms times 365 days. So this hotel sold 16,702 rooms in the year of 2022. Got that? Easy? Good? Number of rooms sold by number of rooms available. And real quick on that, how many of you guys know hotel rooms are a perishable product? You guys get that? Does that make sense? It's perishable. It doesn't mean they rot and you have to throw it away. Not that kind of perishable, but it means I have 65 rooms to sell today. And then tomorrow I have 65 rooms to sell. But if I don't sell all 65, I can't go back and resell tomorrow's rooms for today, right? Today's gone. That's over with. I can't sell those rooms ever again. I got to sell 65 today and tomorrow and tomorrow. That's why it's so important to sell as many rooms as you can, right? Um, so just a quick history, in the industry, people used to focus on occupancy. Then they moved to average daily rate, which we're going to talk about next. So ADR is average daily rate. And your formula for that is your revenue for the period divided by rooms sold, right? So that's your formula for your average daily rate. Make sense? You're just saying, this is how much revenue I made. These are how many rooms I sold. This is my average. Okay. Got that? Makes sense? That's your average daily rate. And the reason they used to focus on that is people would kind of boast about it and say, oh, I've got, $150 average rate or whatever. And then the industry got smart and said, wait a minute, wait a minute. We need to focus on RevPAR. Anybody know what RevPAR means? Any thoughts? They're telling you right in here, it's revenue per available room. So easy calculation too. There you go. Tamika's got it. Revenue, so your room revenue for the period divided by your available rooms. And the reason why RevPAR is so important is it really tells you, um, how efficient you were in selling your hotel rooms. It averages in those rooms you didn't sell in at 0, right? So if we sold, it's really telling you how much money did you make for all the rooms you have in your hotel. These were 0, these were $100, these were $200, right? So what you really want to focus on when you own a hotel is your RevPAR, because if I have a room sitting empty, I'd rather make something off of it than nothing, right? I don't want to sell for $20, but I need to make something off of it versus nothing. So everybody good with that? Occupancy, ADR, RevPAR makes sense. It's hard to do due diligence on a hotel if you don't know these three metrics, right? These are your KPIs, your key performance indicators. You need to know what these things are. It's pretty simple. All right, so what this is now saying is it's now giving you how your hotel ran here. These are your hotel numbers. Then it's comparing you to your comp set. So that's your competitive set. That's your competition, right? How did your hotel do versus the competition? So if we look at 2022 as an example, the hotel ran 70% occupancy, the competition ran 66. So is that good or bad? Did the hotel do good or bad that year? I know you guys don't like quizzes. Everybody had a hard day at work. Kids are screaming. Good. Tamika, she's right. Good, good, good. Thank you. All right. So now this is giving you your index. Index is really easy. It's just dividing what you did by what the comp set did. You don't believe me? Let's calculate it. 70.4 divided by 66.3. 106 point whatever, 1%, right? So you ran 106. Anything over 100 means you're doing better than everybody, right? You're getting more than your fair share. So the hotel did better in occupancy. Average daily rate, the hotel ran 125, the comp set ran 131. Good or bad? There's no trick question. This is easy stuff, guys. Easy stuff. Hotels has there's easy math in hotels. Did the hotel do good, better, or worse in the comp set? Bad. Needs improvement. Did not hit 100%. Yes, perfect. Okay, so it didn't. But remember what I said, we want to focus on RevPAR. So RevPAR, the hotel did 88.31, comp set did 87.5, so it did just a little bit better than the comp set. So it's doing okay. Not great. Okay. We're moving on to 2023. Let's see. And the reason this is important, if you're a passive investor, you need to understand. Remember, at the beginning, they said that this was a value add deal, meaning, and you should be hearing this from a GP. The GP should be saying, hey, we know this hotel is underperforming compared to the competitors, and we can do better. And this is why. And here's the numbers, right? But you need to make sure this stuff makes sense in your head when you're seeing the deal or where you're an investor and people are, pitching their deal, make sure this math checks out, right? Not everybody's math is super clean. So, all right. So now we're moving on. 2023, hotel ran 61%, comp set ran 58. So again, it did better in occupancy and it did worse in average rate. It did a little bit better than the year before, right? The comp set was kind of flat and the hotel moved up. You can see that here. The hotel moved up 3%. The comp set was flat. Um, and in terms of RevPAR, it did $80. Comp set did 77. So it did better by 3% or 2.1% better than the prior year. So that's good. But this is bad. These are bad numbers right here, right? And they're bad because what is it telling you? It's telling you that the hotel's not making as much money in 2023 as it did in 2022. And not only is the hotel not making as much money, the competitors aren't making as much money either. So it's a more of a market dynamics as well. So that's not good. So let's move on to 2024. 2024, we got bigger problems, right? Hotel runs 61.7, market runs 64. So the hotel does worse than the year before. The market moves up 8%. The market's almost getting back to what it did in 2022. Okay, so hotel did not get 100% ref or occupancy index, so that's not good. Then in ADR, the hotel lost $10, almost $10. Not good. Okay. And the comp set lost $7. So this is also not good. Um, didn't hit the 100% again. So now our RevPAR $88 in 2022, $80 in 2023, $73 in 2024. Right. So you're probably saying, like, Tommy, why are you looking at this deal? What do you want with this place? Right? Just move on. This place is trash. Um, but sometimes that's where the opportunity is. And why it's interesting is you can kind of see a reverse trend here. Comp set dropped $10 here, so that's not good. But the comp set is doing better now. They're picking back up. They're still not back to where they were, but they're picking up. Okay. So this hotel went from 100% RevPAR to 103 to 92. So that's not good. Okay. So that means there's opportunity. If at a minimum it was doing what the comp set would do, it could pick up almost $6 in RevPAR. And let's calculate what $6 in RevPAR does to a 65 room hotel. So $6, okay, 6.00 times 65 rooms, okay, times 365 days. So that's $142,000 more just by getting even to what the market was doing. Does that make sense? $6 times 300 times 65. So that's $390 per day, okay? Times 365, $142,000. Makes sense? Now that's just top line. Not all that money comes down to your bottom line, but that's more revenue. It doesn't all go down to the bottom line because I still have to pay people to clean the rooms. I got to pay to, utilities. I got to pay the franchisor, all those things. But a good amount of that will come down. Probably a good, 50% of that will come down. Um, so that's another $70,000 to your bottom line. If you're buying the hotel, if you were to sell the hotel at an 8.5 cap, let's say, that means you can improve the value of this property by 837,000 just by getting even. I know you guys following any of that math? We need to run through it again. Yeah, so if you were to buy this hotel and somebody says, "Oh, you can improve the value by $3 million just by improving top line revenue," I would argue with them, right? Because we just told you it's 837. That's still good. That's still found money. So we've already talked about this a little bit, but we talked about comp set. Again, these are your competitors, and we already kind of called that out. If you'll remember, we said the Hampton Inn was next door. There's this Sure Stay, I guess now. Uh, you have a Comfort Inn, you have a Fairfield Inn. So this is what's making up your comp set. And I think that's a pretty good comp set. Be careful with these sometimes though, because people can put in stuff that you really don't compete against. And the reason they do that is to make the hotel look better. So um, sometimes they'll put in hotels you don't compete against to make the hotel look worse and to tell you that there's an opportunity. So be careful with that. So let's see. Now we're going to move on and look at the financial statement. So what we have here is, um, sorry, we have the P&L for the hotel, right? Your profit and loss statement showing what the hotel did in 2023 and what the hotel did in 2024. So um, if we look at it, we're going to look at this from a number of ways. We already know what the occupancy ADR is. We already went over all that. We already went over RevPAR. So now we're looking to see what's the room revenue, what's other operated departments. So other operated departments, as an example, in a hotel is think about like your gift shop, or maybe you're getting charged for pet fees or resort fee or parking fee or anything like that. That's your other operated department. It's really weird that in 2023 there's nothing there. I'd say that's pretty much impossible because Holiday Inn Expresses have a gift shop. They're gonna charge, you know what I mean? Like there's some other money that's coming through from this place. So I don't know why that's zero, but that's not good. Um, because it went from 0 to 11,000 the next year. Anyways, we'll kind of keep um scrolling through this, and we'll look at a couple things. So one, what's your gross operating profit? In this case, it's 617,000. So that's 32%. Let me zoom in so we don't have to squint. So that's 32% of your room revenue or your total revenue. Uh, in a hotel like this, that's not a good number. At a minimum, you should be able to push that to 38, more like 40. Um, and probably even 42% really is where your GOP should be. So that's not good. A couple other things to note. Look at insurance. Went from 100,000 to 153,000. So that's a big jump. That's 50% jump. So the question is, why did it do that? What's driving that? What's the real issue there? Uh, was it was there some big claim? Is it that the market, there's a big hurricane? Um, Sometimes it's because the owner has another hotel that was hit by a storm, and this is all one policy. Angel, you're right. You're down in Florida, so it could have been that there was a big storm in 22, and then everybody increased their insurance. But it's a number you want to keep in mind, right? Because you have to underwrite this deal, or you have to at least look at the GP's underwriting to understand if they, if it makes sense or not. So let's go to NOI. So that's your net operating income. Did 345,000 in 2023. What's 18%? That's pretty terrible, really. Um, you know, it depends on who you listen to. A lot of people will tell you that a hotel like this should do 30 or 32%
We
of net
speaking of the
operating
calendar, we got
income. So, um, if you look at this, it's a lower RevPAR, so it's probably not going to do 32%, but it's pretty easy to expect that you should be able to push this by a good 6, 7, 8, or 9, maybe even 9 points in margin. So let's do some math. Remember, I told you that we know we could pick up another $142,000 uh, in revenue just by getting even on RevPAR, okay? And we said you'd flow 50% of that, meaning 50% of that would be more profit for you. So we've already said we can give you another $71,000 in profit just by improving top line, okay? So, but I think you can do another, let's just be conservative and say 7 points or 7% in net operating income. So 7%. Let's go back. Let's think about it. The hotel did 1,770,831. We said we can do another 142,000. Remember, by just improving the top line. Okay, so that's 1.912, and let's say we could take it from 19% to 27%. So 0.27. So that means your NOI goes up from 343,000 to 516,000. I think that's a safe, albeit conservative estimate. I think you probably do better than that because we just said you're getting even on on RevPAR, and I think you can probably do better on NOI margin. So that's pretty significant. You're going up from 314,000. If this hotel was run just a little bit better, they should have made another $170,000 in profit. So let's go look and see what their pro forma says. You guys following me on that? Any thoughts, comments, questions, concerns? So this deal, this is what the broker's pro forma is, or maybe in your case, this is the pro forma that the GP or the sponsor is going to share with you. So now they're going to go say, okay, this is what the hotel should be running. So they're saying it should run 2.2 million in year one, two, three, two, four, two, five, two, six. Okay. All right. And look what they did to the NOI margin. Remember I told you most people say they should do in the 32 or more. This is pretty aggressive. 40%, 42%, 43%. It's pretty aggressive, honestly. Um, you could argue it's a 65-room hotel, so there shouldn't be a lot of expenses. Uh, but I think that's too much, right? And look, it's no surprise. A lot of brokers are going to give you deals that are just, they're just pushing it. Maybe it'll do it, maybe it won't. Who knows, right? But usually, when you do your own underwriting, you'd probably want to see whoever's pitching you the deal be a little more conservative. Make sure that they're not giving you a deal that's really aggressive. You want to hear them. You want to hear those words come out of their mouth. I've been conservative in my underwriting, and this is why, and this is how. So, does all that make sense? You guys follow me on that? Thoughts, questions, concerns so far? You tracking? Everybody still awake? So the rest of this, as you kind of go through, they're going to tell you all about the market and things like that. I want to pull up real quick another deal. We're going to flip off of Vero Beach and give Florida a rest. I want to show you guys another deal that was pitched by a different group that I work with. And the reason I want to show you this is, in case you haven't seen it, I'm sure you've seen things like this, but I want to just give you a refresher on it. Is to show you, um, let's see, where did it go here? Give me 1 second. Okay, here it is. I want to show you what some of the investor returns are and things like that that they may pitch to you. Can you guys see this okay? So, if you look at this, this is a deal that I saw not too long ago. And it's helpful because it shows you what the investment is, right? So this is like an illustrative example. Okay. You're going to invest $50,000 into the deal. They're telling you some other things that are, kind of deal points. So the hotel management fee, what the other fees are. And then they're saying the total equity is $1 million. You're going to put in 50,000. So your percentage of ownership is 5%. And then they're saying here is, what are your returns going to be, and how will you get your money back, and what will that look like? They're saying here, year one is $50,000 that you put in. You invested 50,000 into the deal. Okay. Year one, you're not going to get a preferred return. Everybody know what a preferred return is? You guys familiar with that? Questions on what that is? So, um, just so we make sure we're on the same page, the preferred return is, a percentage that they're going to give you as an investor, that it's almost a guaranteed, essentially like a guaranteed return on your money, right? So if you look at this one, um, you'd be getting $4,500 for your initial $50,000 investment. So that's your preferred return every year. And it doesn't have anything to do with the cash flow of the deal. So in this case, it's a 9% return, right? 4,500 divided 50,000, you get 9% preferred return. And then you're going to get money based on the cash flow of the deal. In this case, they said you own 5%. So
he was using got
depending on
compromised.
what the hotel cash flows, you're going to get 5% of whatever that cash flow is. Okay. So year one, the hotel didn't cash flow much, so you got $38. Year two, you're going to get your preferred return of 4,500 plus your 5% cash flow. So you got $5,100 that year. It kind of goes so on and so forth until year five. Year five, in this case, they're saying you're going to sell the hotel, right? So you're going to get your $50,000 back. You're going to get 9,000 because they're catching you up on what you didn't get year one. So it's 4,500 plus 4,500. You get your cash flow there, and then you're going to get your 5% of whatever the profit is on the deal. This is now, this is all perfect world. We're living in, the land of Oz in a perfect world. And in this case, the hotel sold, it made money, and you made an extra 39,000. So total, you made $38 here, 5,000, 6,000, 6,000, 79,000, right? So your total internal rate of return is a 15.6%. Your equity multiplier is a 1.95. So you almost got 2 times your money on that deal over a 5-year hold. So, not every deal comes with preferred return. Some deals do, some deals don't. Um, just these are just things you want to think about, questions you want to ask. You know, and look, I could walk you guys through this for hours and hours and hours upon end. You'll fall asleep, as my wife would say, and but I won't run out of things to talk about. So I want to make sure we're leaving time for questions, comments, concerns, sort of open up the floor to you guys because this is your time, to ask what questions you guys have for me. So I was and again covering it in broad strokes, but feel free to type into the chat or come off mute for questions you have on hotel due diligence as a limited partner. That makes sense. You guys have a better understanding of what to do and how to make sure you're understanding the deal and is it a good market and all that. Don't be shy now. Jessica. Okay, so Angel, what types of report do you request from CoStar when analyzing a deal? So, yeah, if you have CoStar access, I don't know if you guys are familiar with that. CoStar is sort of a online repository of hotel, not only hotel but all kinds of asset classes, multifamily, all kinds of stuff. But um, you can ask for a couple things. One of the reports I like to look at is a hospitality submarket report. So I could show you what one of those looks like. Let me pull one up real quick for you. I think I had one pulled not too long ago. So you can look at a hospitality submarket report because that's going to tell you, um, it's going to tell you what deals have sold recently. You might look for some comp sale information from CoStar. So I looked up one deal in New Orleans not too long ago. This tells you. Um, it tells you a couple of different things. What's the occupancy, ADR, and RevPAR in that market. You know, this is over. Look, this is for the month, 3 months, whatever. So this is telling you, how's that market? What are the market dynamics? What's happening there? What's the historical average? Where are they forecasted for the market to land? So you could read through there. A couple things I like to focus in on here is I'll kind of flip through a couple things and just get you to where I like to look at. So one is under construction properties. So here this is telling you who's building what in the area. They're saying they're building a Fairmont, an Element, and an Independent hotel, kind of all in and around the French Quarter. Um, so that's important because you want to know, hey, is somebody building a new hotel right next to me? Because I'm going to have competition. This is telling you what hotels have sold in the last year, how much have they sold for. So I remember Davon telling me she bought this Ritz Carlton. She paid 141 million for this deal, so she just cut the check, no problem. This court, I'm just joking, but maybe one day when Vesterr sells. Courtyard sold for 53 million. That's 231 a key. So it's interesting to know, like, hey, when was the hotel built? How many rooms was it? What's the brand? What's the class? We didn't really talk about class too much today, but that's really saying, like, is it luxury? Is it economy? What type of property is it? Um, and then when did it sell? So that's helpful because maybe you can get some comp information from that. So that's good information. The other thing that I'll tell you again is this overall performance in like a 10-year run of how has this market performed. You can see here like some pretty big anomalies. That's COVID, right? So COVID hit hit every industry hard, but hotels it hit particularly hard. So these 3 years are kind of strange years, you'll see. Um, and then it also forecasts out what it thinks the market's going to do in the future. New Orleans had Super Bowl in 2020, I think it was 2024. So that was why it was up so much there. And then that's why they're also projecting, 25, 26 to be down, right? So, um, and then it'll break that down a little bit more by chain scale. So they'll say if you're probably not looking at luxury hotels, but maybe you're looking at an upscale hotel or a mid-scale hotel, and they'll tell you, how that's changed. If you see these grayed out, it just means there's not enough hotels reporting to give you, data that's clean. So they won't report if they think you can figure out specific hotels numbers. So they need to have a lot of hotels to report out the numbers. So that's a good question. What else you guys have for me tonight? The quiet group. Angel asked, do you not only forecast out supply and demand for the submarket? If so, any recommendations? Yeah, I mean, I think that's kind of fair, sort of what we talked about. I mean, I think, you do have to look at supply and demand for the submarket, and this will tell you that this will give you supply and demand numbers, but essentially that's what we just talked about, right? We just talked about supply because we talked about what's under construction, and we talked about demand because this is saying, the numbers kind of correlate. So you might see a big, if there's a lot of hotels that were developed one year, it came online, you might see a bigger increase in supply. Uh, and vice versa, the demand changes should correlate to RevPAR changes, right? So there's not a lot of changes expected here. Um, these are available rooms, so just think about available rooms. You have to divide all these by 365 to get the number of actual keys that are added into a market. So this is 136,211 divided by 365. So if somebody's adding in 373 more keys or room nights each night into that market. Does that make sense? Um, um, what else do we have? So yes, you should be able to get a recording for sure. So um, yeah. All right. What else you guys have? Any other thoughts, questions, concerns? Are we all ready to buy our first hotel now? Get it on Vesterr, make some money, or if nothing else, ready to invest in your first deal, or at least become more equipped to understand what questions you should ask, right? You want to make sure, again, you're comfortable with the location of the hotel, you're comfortable with the age, you're comfortable with the price that's being paid. We didn't focus a lot in on that today, but you're comfortable with the game plan, right? So, what's the game plan for the hotel? Are we going to buy it? Are we going to change flags? Are we going to buy it and just improve, revenues? Are we going to improve operating margins? Um, So Angel asks, what's the thoughts regarding branded versus independent? So, and just so everybody's clear, independent meaning it's not attached to a flag like a Hilton or Marriott or one of those systems. I don't have a problem with independent hotels in the right markets. And look, New Orleans is a prime example of one of those markets. Um, you it's not uncommon to go stay in an independent hotel, and independent hotels can do really well in this market. Now, would I want to buy an independent hotel on the side of I-95? No, that's not a good idea, right? This market has enough demand on its own that you don't necessarily need to have a brand helping you drive rooms. But generally speaking, you're going to have to spend more money on marketing and e-commerce and all of those things when you don't have a brand. The brand's already spending that money for you. They're already driving awareness, which is why you pay them your franchise fees. Um, so again, I don't mind independent hotels, but they need to be in the right area. Big markets, it's probably fine. On the on the beach in Miami, you go up and down Ocean Boulevard or Collins, you see a lot of independent hotels, and that's people are cool with that. That's fine. You don't necessarily need a brand, but that's South Beach. It's its own demand generator in itself. So um, makes sense. These are good questions. I have time for a couple more guys, so just drop them in there. All right, guys. Well, thank you for your time. Devon, I'll turn it back over to you for closing commentary. But it was my pleasure. I appreciate you guys connecting tonight. Oh, there's a couple questions. We'll jump into these. Financials, you know, there's a lot of different things to look for. One is, is the hotel operating on a you know, in a margin that makes sense, right? We just kind of looked at that Holiday Inn Express and said, it's not operating at a level that's uh, within industry norms. It's operating at a lower level, right? So there's room to improve on that. And it's hard to know that right off the bat, but as you get more and more comfortable looking at these financials and you sort of compare one hotel to another, you might say, okay, well, why is this one not doing as well as this one? You can also ask people like me or Devon or whatever, and we can help you out with that. Or everybody goes to Chat GPT and it tells you all the secrets anyways, which I'm gonna laugh about because that's usually wrong when it comes to hotels. But um, other things to look for in financials, if you're buying a hotel that doesn't have great history or, it's not really like a institutional owner, let's say it's kind of, just a family that owns it, you have to be careful with those because usually you're going to see you're going to see that they're doing a lot better than what it really should do, especially if you're not willing to go move there, run it yourself, and have your kids clean rooms and whatever else they do. So you're going to want to think about that because usually that means you're not able to run those same margins if you were to own it, right? If you're going to own it and you're going to hire somebody to run it and all that, chances are you're not going to run it as efficiently as they do. So just be careful with that. Um, the Fed's telling us trouble in 2026. How do you look at macro environment? Yeah, I think the way to protect for yourself from that is just to be really particular about the market, right? So making sure that you're buying into a hotel that's got really solid demand generators, right? I-95 isn't going anywhere. Now, if there's a recession, are people as many people going to travel as usual? No, so that's a problem, right? But if you're buying a hotel that's in a military town, that's in, like I'll give you an example, like a Fayetteville, North Carolina has Fort Bragg. Fort Bragg's the biggest military base, I think, in the country. It's not going anywhere, right? So that's an example of a good demand generator. Maybe you're buying a hotel that's next to a university, right? Or it's maybe you're buying one that's on the beach. Okay. I mean, you want to just be really smart about what areas you're getting into. And it's cyclical. Sometimes if you think about there being a recession, that can be a time to buy a hotel, right? Because that means maybe somebody's got to sell because the hotel is not doing well and you can get it at a cheaper price. So it's not always bad news, right? Just think about that as a way it could help you. So. All right, guys. Thanks for your time tonight. We appreciate it.